The DALBAR study tracked the behavior of real investors over 30 years. Here's what they found. During that period, the market grew an average of 10.3% per year. The average investor earned 3.7%. Same economy, same assets. A gap of 6.6 percentage points every single year.
Wait, the market grew 10% and people earned 3.5%? How is that possible?
Because people sold when the market dropped and bought after it had already risen, again and again, over 30 years. Today, we'll break down why this happens and how to fix it.
That sounds like just bad decisions.
That sounds like biology. The same mechanisms we've discussed in previous episodes, now working against your investments. Emotional investing is when financial decisions are driven by fear or greed, rather than analysis. And this isn't about weak or inexperienced people, it's about everyone. Professional fund managers make the same mistakes for the same reasons.
Even professionals?
Research by Terence Odean from UC Berkeley showed individual investors, on average, sell winning stocks too early and hold losing stocks too long. Exactly the opposite of what's needed. Why? Because selling a stock that has risen means locking in pleasure. Selling one that has fallen means admitting a loss.
Loss aversion from episode 1?
Exactly. The pain of loss is twice as strong as the pleasure of gain, so the brain holds losing positions hoping they'll recover and cashes out winners fearing they'll fall back. Both decisions are emotional. Both are costly. This is called the disposition effect, one of the most documented patterns in behavioral finance, and most investors have never heard of it. Now let's break down the most expensive mistake: panic selling. The market drops 20%. What does the brain feel?
Terror. Sell immediately.
Exactly. But let's look at what happens biologically. A market drop activates the amygdala, the fear center we discussed in detail in episode 7. Cortisol spikes. Tunnel thinking kicks in. The brain enters survival mode. In survival mode, one thought: get assets out of danger, sell, exit, protect. This is jungle logic applied to the stock market.
But if the market is falling, isn't selling the right call?
Look at the numbers. If you invested $10,000 and the market dropped 30%, you have $7,000 left. If you sell at this point, you lock in a $3,000 loss. Real, permanent. If you don't sell, the loss only exists on paper. Markets have historically always recovered. We talked about this in episode 2. Those who stayed recovered everything. Those who panic sold locked in a permanent loss.
But it's painful to watch it fall.
It is, but you know what hurts more? Missing the recovery. JP Morgan research shows if you missed just the 10 best days in the market over 20 years, your returns drop by half. And those best days often follow immediately after the worst ones. Selling in panic almost guarantees you'll miss the recovery. Here's the paradox that explains most investing mistakes. When the market has been rising for months, everyone is talking about investing. News is positive. Friends brag about their returns. You feel now is the perfect time to get in.
Yes, that's exactly what I thought.
But at that moment, the market is already at or near its peak. Herd mentality from episode 3, everyone is buying so I should buy, brings you into the market precisely when prices are highest. And when the market falls, those same news outlets scream about crisis. Those same friends go quiet or complain. You see assets are cheaper, and you want to exit right when everything is on sale.
So psychology makes me do the exact opposite of what I should?
Buy high and sell low, systematically. Because of herd mentality, loss aversion, and present bias, everything we covered in episode 1. Buffett didn't just say something clever with "be fearful when others are greedy." He literally described how to avoid the main investing trap. Enter when it's scary, hold when it hurts, don't react to news. Let's come back to the disposition effect because it costs enormous amounts of money. Imagine you have 2 stocks. Stock A is up 20%. Stock B is down 20%. You need money for something important. Which do you sell?
Probably A. Lock in the profit.
Most people do exactly that. But rationally, if both stocks have equal prospects, you're selling the one that will likely keep rising and keeping the one that may keep falling. Odean's research found stocks investors sold to lock in profit went up an additional 3.4% on average over the next year, while stocks they held to recover fell an additional 3.8%. The price of the emotional decision? Minus 7.2% relative to the rational choice.
Wait, by not selling the loser and selling the winner, I lose another 7%?
On every such cycle. Multiply that by years of investing, and that's where the $50,000 gap comes from. Another destructive pattern, trading on news. Bad inflation data came out, sold. Geopolitical tension, sold. A bad quarterly report from one company, sold the entire portfolio.
But you have to respond to information.
Depends on the information. A long-term investor in a diversified fund is not investing in one piece of news or one quarter. They're investing in the growth of the global economy over decades. One bad report doesn't change that thesis. Research shows investors who check their portfolio daily trade significantly more and earn significantly less than those who check quarterly or less. More information, more reactions, less money.
Look less, earn more?
For a long-term investor, yes, because every time you look, the brain evaluates danger or not. And statistically, the more often you look, the more often you see a drop, the more often you feel the impulse to sell.
Okay, the brain is working against me in the market. What do I do?
3 specific defenses. Defense 1, investment plan on paper. Decide in advance. How much of a drop are you willing to hold through without selling? Write it down. If the market falls 30%, that's fine. It's in the plan. When a plan is written in advance, during a drop, you're not making a decision. You're following a plan. Following a plan is significantly easier than making a decision under fear.
Write down what I'll do before the crisis happens.
Exactly. Pre-committing decisions is one of the most powerful tools in behavioral finance. Your calm today self makes the decision for your panicking tomorrow self. Defense 2, automatic dollar cost averaging. Set up automatic monthly investing of a fixed amount, regardless of what the market is doing. This method is called dollar cost averaging. When the market falls, you buy cheaper. When it rises, more expensive. On average, this beats trying to time the market, and most importantly, you remove emotion from the decision.
Buying when the market falls sounds scary.
That's exactly what smart money does. When everything is being sold, assets get cheaper. Automatic buying allows you to do this without emotion. Defense 3, quarterly review. Remember from episode 6, checking your bank account once a week? Same with investments, but even less. Check your portfolio once a quarter, no more. Less contact with short-term fluctuations, fewer impulses to react, more time for growth.
Not looking at the portfolio? That's the strategy?
For a long-term investor, largely yes. The market makes noise every day. Your goal is 20 to 30 years from now. Daily noise has no bearing on your goal. Let's calculate concretely. 2 investors start from zero. Each puts in $500 per month for 30 years into a diversified fund. Investor A, calm, follows the plan, doesn't react to news, doesn't sell in crises, gets average market returns of 10% per year. At the end, roughly $1.13 million. Investor B, emotional, panics and sells during several downturns, misses some of the market's best days. Actual returns, 7%. At the end, roughly $567,000.
The difference is $563,000?
Same monthly amount, same 30 years. The only difference, behavior during downturns. This is the price of emotional investing.
behavior matters more than stock picking.
For most people, yes. The right behavior with an ordinary index fund beats the wrong behavior with the best stocks, because even the best stocks can't be held if you panic at every drop. The average investor earns 6.6% less than the market, not because they pick bad assets, but because they sell in panic and buy at peaks. 3 defenses: written plan, automatic averaging, quarterly review.
Investment plan before the crisis, automatic purchases, check quarterly.
8 episodes in: brain traps, corporate tricks, compound growth, the happiness treadmill, cards, budget system, neurobiology of debt, and emotional investing. You see the full system now. Next video, why you'll never feel rich enough and what to do about it. The Easterlin paradox, social comparison theory, and a question nobody asks. What is money actually for?
Subscribe. This video could have cost you $563,000. The next one might save you your entire life.
Well said.